Florence.
Thank you, Cynthia. So let's bow for a word of prayer. Dear Lord, we come before you this morning. We want to thank you so much for this new day that you've given us. We pray as we begin our session. I pray that you may be in a position to help us to understand, oh Lord. In Jesus' name we pray. Amen.
Okay, so thank you, Florence. I take this opportunity once again to welcome all of us to our session today. My name is Cynthia Kerubo. I'm from the Tax Education Division and Marketing and Communication in KRA, and I'll be your moderator for the day. With me, I have our panelist, Mr. Victor Njeru, and also our sign language interpreter, Madam Elizabeth. I think she's having a bit of issues with her video. Okay, all right. Sawa. Okay, I think we are good to go. So as I begin, let me take this opportunity to welcome our panelist, Mr. Victor Njeru. He comes to us from the Domestic Taxes Department, and he'll be a guest for today. We had arranged or organized to have a second panelist who, out of unavoidable circumstances, was not able to make it for this session, but it's still okay. We have Victor with us. He'll be able to take us through the session today. So as I welcome Victor, let me start with maybe our sign language interpreter. Elizabeth, you can say hi to our participants.
Okay, hello everyone. My name is Elizabeth. I'm a sign language interpreter at KRA, Naivasha office. Welcome all.
Okay, thank you. Thank you, Elizabeth, and welcome to our session. So Mr. Victor comes to us, like I mentioned, from the Domestic Taxes Department of Kenya Revenue Authority, and he is the center head of the Northern Region Audit Center. He has a wealth of knowledge in matters to do with the domestic taxes and revenue acts administrations. Talk about experience. He has over 22 years of experience in tax audits and compliance management across various economic sectors, and he holds a bachelor's BA in Maths and Economics from the University of Nairobi, as well as a diploma in Revenue Acts Administration from a school in Kesra, and he's also a certified public accountant CPA. Okay, so welcome, Mr. Victor. You can just say hi to our participants before we begin.
Thank you. Good morning, everyone.
Morning to you.
Yes, I guess we can proceed.
Okay, so thank you. So like I mentioned today, we are going to discuss a very interesting topic, and that is investment allowances. It's quite broad, but we've narrowed it down to specific sectors, that is education, manufacturing, and some other few sectors. But if you have any question with regards to this investment allowances, this topic, you can please type it on our chat, or you can be able to raise your hand. We'll be able to answer your question at the end of the session. So without much further ado, allow me to begin with the basics, and over to you, Mr. Victor. You can maybe just give us an overview and tell us in brief what is investment allowances.
Thank you, Cynthia. Maybe I start by digging a bit further from investment allowance so that then as we come to it, we know exactly what we are talking of. We are in the Income Tax Act today because the whole of the discussion will be centered in matters that are anchored in the Income Tax Act. Also, we are looking at a person who is in business, and in the course of running a business, they incur expenses. Now, business expenses can be classified into two broad categories: revenue expenditure and capital expenditure. Revenue expenditure are those expenses that you meet on day-to-day running of your business, and whatever you acquire from that expenditure is exhausted within the tax period that you are reporting. And usually for income tax, we talk of 1 year. If I give an example, if you are a transport, you're in the transport business and you fuel your truck to ferrying goods from Mombasa to Maraba, that fuel will be expensed within the trip. Tomorrow you have to fuel again. So that's an example of revenue expenditure. But you also incur the expenditure to acquire the truck. Now, when you transport goods from Mombasa to Maraba, the truck will still be there. You'll use it tomorrow, you'll use it the day after, you'll use it next year. And depending on how well it's serviced, for several years. So that is capital expenditure, meaning it has enduring benefit. You use it for more than one tax period. So revenue expenses are usually allowed under Income Tax Act as guided under Section 15. Capital expenses, on the other hand, are not allowable. You go to the Income Tax Act, Section 16, it says capital expenses are not allowed. But then when you come back to Section 15, you'll find that it has given a window where you can claim capital expenses as guided again in the Act. So investment allowances are part of these expenses, capital expenditure, that is allowed under the Income Tax Act against business income. I think now we are clear on what investment allowance is. It is capital expenditure that is allowed against business income and under the Income Tax Act. Back to you, Cynthia.
Hey, thank you for that overview. So thank you. You have mentioned it's found in the Income Tax Act. Yeah. And maybe you can tell us why was it necessary for maybe this investment allowance to come into law? Why is it necessary that business people should enjoy investment allowances?
Thank you. Again, if we go back to basic accounting, you look at any financial statements for a business, you will find that other than the revenue expenses that they claim for the business, they have capital expenditure, only that then they call it things like depreciation, amortization, different names, and they use different rates. So it is something that is based on best practice in terms of accounting. But then we do not go the way of accounting. Now, it is regulated under the Income Tax Act for the following reasons. One, we agree, just like in accounting, that we want to compensate for diminution in value. If you are doing trade using an asset, this asset will not be there forever. As much as it will span several years, at the end of the day, it will be exhausted. If it is a truck, as in the example I gave earlier, You'll not use it for 10 years. You probably use it for 4 or 5 years, then you realize now its returns are not matching the cost of maintenance. So you have to do away with it and get a new truck. So number one reason for giving investment allowance is to compensate for that diminution in value in the asset that is being used to generate income. And then we come in now to government policy. Other than compensating the business for that diminution in value, allowing them to claim that cost, then it is used to shape government policy. That, for example, we want to decentralize investment from towns or from certain regions. So an investment allowance is granted in a certain way to encourage businesses to invest away from a certain area or into a certain area. For example, you might have gone to towns where that town is synonymous to a certain company or a certain firm operating from that region. So it is in the best interest of government to encourage investment away from, say, Nairobi, to have someone set up a big company, a big operation in Madeira. And thereby they will attract other people to invest in that area and make that area grow. So we decentralize from Nairobi. Nairobi is congested. So how do we make other areas also grow? Then it can also be used to attract investment, because some areas are so expensive to invest in and returns take time to come through. So how do you encourage businesses to venture into such areas of trade? Again, through an investment allowance, it's one of the ways that you can encourage investment into an area that is probably slow to pick, requires a lot of capital. Yeah, so for example, in oil exploration, you can imagine you start exploring for oil today. You're not even sure whether you'll get it. It takes years just to do the exploration before you can even start extracting. So how do you encourage investors to come into that area? And again, it requires a lot of capital. So you give some incentives in terms of investment allowance.
Sure.
Yeah, those are some of the reasons why, actually the main reasons why we have investment allowance.
Okay, thank you for that elaborate explanation. That it's somehow investment allowance is allowed so that somehow the business people can get compensated for those assets that depreciate in the course of doing their businesses. It's also in the best practices that the government tries to see how there can be decentralization of these investments, maybe from areas that are densely populated to other towns. And also you've mentioned about it's a way of encouraging or attracting investors into who have ventured into a certain business or are venturing into certain businesses. So maybe you can also tell us if this is a new thing or this investment allowance has been there in the law. Is it a new concept or has it always been there?
It's not entirely a new concept. Maybe the terminology is new. Prior to April 2020, when the old second schedule was repealed, we used to have it in various names like investment deduction, wear and tear, industrial and building allowance. Then after the repeal of that second schedule back in 2020, now everything was compressed and brought in as investment allowance, which has made it quite easy for both businesses and the tax administration to administer the provisions.
Mm-hmm. Okay.
Yes. To answer your question, It's not new. It's something that has been there for
But
decades.
under a different name.
Under different
Or
names.
under different names. Okay.
Different
All right.
names and different rates.
Okay.
Yes.
So maybe before we talk about the rates, you can maybe tell us, you've explained to us what it is, why it is there, why it is in the law. So maybe you can tell us who's this who qualifies to get the allowance, and then they get the investment allowance on which assets. So which assets qualify for investment allowances, and then who qualifies for these investment allowances?
Thank you. There are a number of businesses that qualify. The biggest beneficiary is the manufacturer. Remember, we're saying that it is used to direct investment in line with government policy. And if you look at our Vision 2020, of course, the manufacturer appears there prominently, housing. So we have those in manufacture. Real estate also enjoys this. Education, we have hospitals, we have ships and aircraft, we have transport business. Actually, it's quite broad. If I were to go through the list, we have hotel building used for manufacture, hospital buildings, petroleum or gas storage facilities, education buildings, machinery used for manufacture, hospital equipment, ships and aircraft, motor vehicles and heavy earth moving equipment, furniture. So again, this is now for most of the businesses, furniture and fittings, telecommunication equipment, filming equipment by local licensed film operators, machines used to undertake operations under prospecting right, machines used to undertake exploration operations. So it is broad. It tries to cover most businesses, only that then now as we come to the rates, you realize that some operations, some businesses, some areas get better rates than others.
All right. So thank you for that. I've seen some questions already coming in, but I'd like us to just proceed with the discussion. Maybe your question might be answered in the course of the discussions. So I have seen them coming through. So to our participants, we'll be able to, if your question will not have been addressed by the time we are done with the today's presentation, then we'll be able to pick it up. But just to mention that I can see your questions, and even for those who've raised their hands, I'll give you a chance maybe towards the end of the session. So thank you, Mr. Victor, for that elaborate answer. So as you were talking, you spoke about rates. So how are the rates, and when is this investment allowance claimable by the businesses or the assets you've mentioned?
Yeah, thank you. So investment allowance is claimable from the first year of use. So that is the trigger.
First year of use, eh?
First year of use. You may take 5 years to construct a building or to put up a plant, but until you bring it to use, you do not claim the allowance. In the first year that you bring it to use, then you make the claim, you claim the allowance in line then with the rates that are listed in the second schedule. Yeah, so first year is key.
Okay. All right. So what about the rates that you were talking about? You said some assets or some businesses enjoy different rates from others. Maybe we can
Yes.
talk about the rates.
Yeah. So we look at the rates. So the first thing is capital expenditure incurred on buildings. So for hotel building, you claim 50% of the cost of the hotel in the first year of use. Building used for manufacture, again, 50%. Hospital buildings, 50%. Petroleum or gas storage facilities, 50%. So those four buildings get a rate of 50%.
50.
Yes, that is in the first year of use. Then for the same buildings, you then claim 25% in the second year of use and another 25% in the third year of use, making it 100%.
Yeah.
For education buildings, it is 10% per year. So this goes for 10 years. For commercial buildings, again, it is 10% per year. So for education and commercial buildings, the rate is 10%. Yeah, so then after buildings, we have machinery. Machinery used for manufacture is claimed at 50% in the first year of use. Hospital equipment is claimed at 50% in the first year of use. Then ships and aircraft, 50% in the first year of use. Then again, the remainder, the residue, is claimed at 25% in the second and third year in a straight line. Motor vehicles and heavy earth moving equipment, so, small cars, buses, trucks, the diggers, it at 25% in equal installments. So again, you'll exhaust these in 4 years. Computer and peripheral 25% in equal installments. So again, these ones will go for 10 years. Furniture and fittings, 10% in equal installments. Telecommunication equipment, 10%. Filming equipment by a local film producer licensed by the cabinet secretary responsible for filming, 25% in equal installments. Machinery used to undertake operations under prospecting rights, 50% in the first year and 25% in the subsequent 2 years. Machinery used to undertake exploration operations, again 50% and 25% in the second year and 25% in the third year. Other machinery, 10% per year in equal installments. And then there's purchase or acquisition of an indivisible right to use fiber optic cable by a telecommunications operator, 10% in equal installments. Then we have farm works, 50% in the first year of use and 25% in equal installments. That is the second and third year. Yeah, so those are the rates, the common rates. There's one more that we'll find listed after this, but maybe we can first react to the rates that we've had here. There are a lot of terminologies that have been used.
Sure, yeah.
Yes.
So broadly, you've said that the assets that qualify for investment allowances are like broadly categorized into like 4 or 5. So we have buildings, where you mentioned about hotel buildings, hospital buildings, and all that. Then we have machinery, right?
Yes.
We have machinery where you've talked about those earth moving equipment and all that.
Yes.
And then we have farm works, if I'm not wrong. And
Yes.
then farm works here, we are talking about the tractors.
There's a definition for farmers. Forgive us, we seem to love definitions, which we
Yeah. Like it
yeah,
enhances our understanding.
yeah.
Yeah.
So in a farm, you'll find there are many things on that farm. For you to grow crops or to take care of animals, you'll have a farmhouse, labor quarters, other buildings on the farm that are necessary for operation of that farm. You'll have a fence so that your cattle do not run away, or cattle from the neighbor do not invade your farm. You need to take your animals to a dip, so you'll find a dip. You'll have drainage. You'll need water and electricity on the farm, and generally other things that will be necessary for the operation of that farm. Yes.
Okay.
So that is what constitutes farm works.
Farm works. Okay, that's very clear. And then the other asset that qualify for this, you mentioned about fiber optic.
Yes, the purchase of undefeasible right. Remember, fiber optic may be owned by several people. So you are getting a right to use that fiber optic. So you are not owning the whole of it by yourself, but you have the right. So you've made a capital sum to kind of purchase a right to use that cable. So that is the cost that you will claim the investment allowance on.
Okay.
Not the one coming to your house. Yeah, it's by telecommunications operators, like in a Safari.
Oh, okay.
Yes.
Oh, I see. Yes.
Yeah.
So, so you mentioned those four broad categories, and you mentioned there's a fifth one which you look into maybe later on.
Yes, it's a proviso that kind of departs from these rates.
Oh, okay.
Yes.
All right. So for us to not get so confused already, because the terminologies are quite heavy and it's quite a lot of content, I beg we take the four categories and then move forward with the rates for the four. And then should there be need, then we can discuss the other. So you've mentioned about the different rates. I don't know whether they apply, these rates apply the same across the country, and if there are variations, why is it that there are, if there are variation, why is it so that in some areas the rates can be different from other areas? So are they blanket rates or across the country, or are they different? And if there are different rates across the country, why is it so?
Thank you. Now, for the rates that we have cited, these ones are uniform across the country. Before the repeal of the old schedule, we had various rates available across the country. Nairobi, of course, Nairobi and Mombasa had the list for obvious reasons that they are too congested. So government was trying to see how to then encourage investment away from Nairobi. But now, then your question will bring in that proviso that I was talking of, which is then the one that will introduce different rates. Now, this is brought forward from the old schedule because the new schedule came in to simplify everything and give the rates as we have cited. But then in the old schedule, there was an accelerated investment deduction rate. There are those who used to get 100%, and there was even 150% investment deduction, depending on where you are investing and the amount that is invested. Now, in that old schedule, you needed to invest more than 200 million outside Nairobi and Mombasa for you to qualify to claim investment deduction, as it was called back then, at the rate of 150%.
Oh, wow.
Now, after the repeal, then remember, for you to invest such a figure, it's something that you do not probably do in 1 year. So there are investors who had already started investing and knowing very well and having done the mathematics that if I invest here and this is the investment allowance that I will get, then I'll be able to break even. Then before they brought the assets to use, the schedule was repealed and that rate was removed. So paragraph 1A was inserted into the new schedule. And if you allow me to read it, there's a lot of English. So the rates that we've given are provided for under paragraph 1. So then paragraph 1A says, notwithstanding paragraph 1, the investment deduction shall be 100%. Remember, in paragraph 1, the highest rate we have is 50% in the first year of use. But now here, this is granting 100%. One, where the cumulative investment value in the preceding 3 years outside Nairobi City and Mombasa City is at least 2 billion shillings. So if you invest outside Nairobi and Mombasa and you have incurred not less than 2 billion, 2 billion is a big investment.
Yeah.
If you go to a remote area and put in 2 billion, certainly you've created growth in that area. When I was in college, we used to talk of multiplier effect. You find a mama mboga there, somebody will have to put up rental facilities for the staff in that company to put up, and many other things will follow that investment. So for such an investment, then the rate is 100%. Then it goes ahead to say, providing that where the cumulative value of investment for the preceding 3 years of income was 2 billion shillings on or before 25th April 2020. This is the date when the current schedule came to force. It's when the Finance Act back then was assented to. Then the applicable rate of investment deduction and the applicable rate of investment deduction was 150%. That rate shall continue to apply. So again, if you've incurred 2 billion by 25th of April 2020, and you have not claimed it, you're expecting to claim at 150%. So if under the old schedule, your rate was 150%, then you are allowed to continue with that rate. Because you've already committed your capital, but the law has just changed, and this is a huge investment. So we are talking again of 2 billion.
Outside Nairobi and Mombasa.
Outside Nairobi and Mombasa.
Yeah.
We want big investments away from these big towns. In the earlier years, Kisumu was there, but it was removed because, again, if you look at Kisumu, there's a lot of land that is not developed around Kisumu. Yes. So they continue with 150%. Then under the same, again, paragraph 1A, it continues to say, where and I reached before. So so where the cumulative investment value for the preceding 4 years from the date. Now, this is a provision that came in 2022. And it's 2023, sorry. So it's looking at 4 years from July 2023, when this section came to force. If you have incurred cumulative investment of over 2 billion. So it's just expanding again to cover, because some taxpayers again were left out. There was a gap in that law. So you're looking at over the last 4 years, you've invested over 2 billion and you are bringing it to use now. Again, you continue with that 150%. So your investment allowance will be 150%. Then it continues to say, if from July last year, for the next 3 years, so 2023, 24, 25, again, you invest 2 billion. So it is expanding the window forward. Again, you will get investment allowance at 150% when you bring that asset to use. So that is all about 150%. So we saw the 100%, then we have seen 150% outside Nairobi and Mombasa. Then there's also another proviso here. The investment value outside Nairobi City and Mombasa County in that year of income is at least 250 million shillings. So here we are not looking at the cumulative. If you invest 250 million shillings outside Nairobi and Mombasa, you claim at 100%.
Okay.
Or the last one, when you invest in a special economic zone, again, your investment allowance will be at 100%. So how was the English in that?
Quite heavy. Quite heavy. Because I think
it's migrating from the 50% maximum that we had seen earlier to now granting 100% in some cases and 150% investment allowance in other cases.
Okay. I think I can pick reactions on that even as we continue with the discussion, because on the chat I can see the questions that are coming up are about this 150% and the 2 billion and outside Nairobi and within Nairobi. So maybe just as before we dilute it, we can maybe we can just pick the question that we had prepared. This one about investment alliance regime. There was a question about please speak on investment alliance regime granted to preferential tax regime areas like EPZs and SEZs. So they different, similar, or special to the ones in the second schedule? Maybe you can speak into that, and then we can pick on the questions that are coming, because I can see they are quite related from different taxpayers, and then we can proceed. We can pick it from there. You've talked about the EPZs and SEZs, so you can speak if the investment allowance given to them is on a preferential tax regime, and yes, if they are given a preferential tax regime.
Yeah, thank you. As we have seen in that paragraph 1A, then if you invest in an SEZ, your rate will be 100%. In the repealed act, we had specific provisions for EPZ, for SEZ, for manufacture under bond, but then in the new schedule, all that has been combined. So if it's not cited under paragraph 1A, then you use the rates that are cited in paragraph 1, the 50%, the 10%, depending on what it is that you are claiming on. So for SEZ, special economic zone, then the rate will be 100%.
Mhm.
Yes.
Okay, so maybe we can pick it from there and ask a question from Ajay Shah. Ajay, thank you for joining us. His question is, I am not so clear on the 150% issue. The panelist says it continues if granted prior to the change of law in 2020, subject to cumulative investment of 2 billion. Please clarify on this. Okay, and
yes.
I think it's similar to what an anonymous attendee is asking, that if you invest, say, 3 billion outside Nairobi and Mombasa in 2020, 2021, and 2022, also in 2020 and in 2023, I invest 500 M, would the 150% be applicable for the year 2023? Okay.
I proceed.
Yes, please.
Yes. Now, the investment we are looking at here is that investment that we are putting to use today. So I'll look at it as, when did you start constructing this factory?
Mm-hmm.
You started 3 years ago.
Mm-hmm.
So year 1, you did the foundation. Year 2, you did the building. Year 3, you installed the machinery. The cumulative value is more than 2 billion. And you are commissioning the factory today. So this is the year where you bring in that claim of investment allowance. Then you claim, if it's outside Nairobi, you claim it 150%. So we are not looking at what you claimed last year, what you claimed the year before. It is what you are claiming today. You've developed it over the last 3 years, not 10 years. If it goes beyond the 4 years that has been cited here, then whatever is beyond the 4 years doesn't fall under this paragraph. So you've been constructing, you've brought the factory to use, or the hospital to use, or whatever other
hotel maybe.
Yes, you brought it to use today. So you've been doing these works for the last 3 years. Then that's when you get 150%. Yes.
In the first year of use.
In the
That's very important, like you mentioned. Yes.
Important.
Yeah. So maybe that one would also answer the question from this taxpayer who had asked about what happens if I commenced my business, say, 10 years ago, and I did not claim these allowances then. Can I be allowed to make the claim in retrospect?
The answer will be no, because again, you shouldn't have claimed in the first year of use. Now, you can go back and amend the year for that first year of use. But remember, again, you cannot amend a return beyond 5 years.
Okay.
Yes.
All right. So we had an example just to enhance our understanding. So there's this example, say there's company A, which buys a building and enjoys 50% investment allowance in its first year of use. In the second year, it sells the building to company B. Does this mean that company A will cease to enjoy the remainder of the investment allowance, and therefore company B will start enjoying the 25% of the residual in its second year of building and use, and the final 25% in the third year of use? So In short, it's who claims the investment allowances in the case of transfer of ownership. How does it work?
Thank
Maybe
you.
you can answer in that context of this example you're using.
Yes. Now, yes, company A has claimed the 50% in the first year.
Yeah.
Then in the second year, they've sold to company B. So what will happen? Company B is the one to claim the 225s. As the new owner of the building, they claim on the residue. Then on the other hand, company A, having sold the building, then will need to compute whether they made a profit or loss in the transaction. And if they are still in business in other areas, they will declare that as either a trading receipt, if it was a profit, or a trading loss, if they made a loss in the transaction. So for the residual value, it is company B to claim. Then company A will do that computation of whether they made a trading receipt or loss.
Okay.
Yes.
And I think that one also answers the question of whether the now new owner gets to claim a fresh allowance. So they will do the
balance.
Residual, the balance.
Yes.
Okay, that's very clear. And then maybe at the beginning, if I can take you back, you mentioned the assets that qualify for this investment allowance. So are there any limitation to the cost nature of assets that qualify? Maybe you can take you back on that.
Yes. There are some limitations. One, if it's a building, the cost of the building shouldn't exclude the cost of land. So if you go somewhere, you purchase land and put up a building, install machines or other equipment, and you start business. When claiming your allowance, the cost of land should not be in it. Even in accounting, we do not depreciate land. Land appreciates.
Yeah.
Then if the cost was met by another person, like you are subsidized by the local authority because they felt if you put up this operation in their area, it will attract other investors. So they subsidized part of your cost. Then that cost that was not met by you should not be claimed. On motor vehicles, if it's not a commercial vehicle, again, there's a limitation where you cannot claim cost beyond 3 million shillings. You cap it at 3 million shillings. Yeah, because it's not a commercial vehicle. Yeah, so that one cannot go beyond 3 million shillings. We are not encouraging purchase of luxury vehicles where cost then is used to knock off profits that would otherwise have been taxed. Yes.
Okay.
Yeah, sure. I think those are the major limitations. And of course, as we discuss all these, remember the second schedule that deals with this investment allowance is anchored on Section 15, Section 15(2)(b). And under Section 15, we allow expenses that are wholly and exclusively incurred in earning the income that you've declared. So again, if you're not earning income, we cannot go for investment allowance. So again, that's a silent limitation coming from Section 15.
Okay. So maybe even as you talk of these limitations, I saw a question about residential property. Do they enjoy this investment allowance, residential property?
No, they do not. Yeah, they do not. In the old schedule, we had a paragraph that was allowing claiming on residential buildings where they were developed in a scheme certified by the minister. Yeah, so in the new schedule, then that one disappeared.
Okay.
Yes, I'm sure the government felt that that is not again a line that they wanted to incur. You remember, when we claim capital expenditure, it is actually the government that is indirectly incurring that cost by foregoing the tax that would have been paid, and the business not claimed this allowance. Yeah, so based on the government policy, at a particular point, some things will disappear, others will come in. Yes.
Okay. Thank you for that. So we spoke into an example where a company sells to a different one. And then, so we said if the first company enjoyed the 50% investment allowance in its first year of use, we said the other company will continue enjoying the remainder of the investment allowance. And then this company A will now go and do their books of accounts to determine whether or not they made a profit, and then declare it in their other businesses. And so maybe you can expand on that and tell us what happens maybe if an asset is destroyed or disposed. What happens then?
Yes, if an asset ceases to be used, because either it's destroyed or it's been sold, again, the trader or the company is supposed to compute to determine whether again they have made a profit or a loss from the disposal. If it's given out for free, then the market value for that asset should be used to establish. Then you have the market value and the residual value that you are carrying in your books as per the second schedule. So if the market value or the disposal value is more than the residual value, then that's a profit. We call it a trading receipt that you subject to tax. If, on the other hand, the residual value is less than the market value, is more than the market value or the disposal value, then it means you've incurred a loss. Again, it will be allowed against your taxable income for that year.
Okay.
Yes. Of course, these are cases where the business is continuing. If you've ceased business, again, you'll do the same computation, but now the name changes to unbalancing change, kizungu tu, or unbalancing deduction. But it's the same concept. Was it a profit? Was it a loss? And you declare it in that year when you've ceased the business. What we like insisting here, because under the Companies Act, if a partnership loses one partner, either they have resigned or for whatever other reason, then it is saying that partnership has been dissolved. But under this schedule, we cannot deem that business to have ceased just because one partner has left. Yes, the partnership under the law that governs partnerships will be deemed to have ceased and a new one started. But for the purpose of this schedule, that partnership continues until or unless all the partners leave.
All right, I think that's very clear. And we are looking now into the last question from what I had prepared. And I think I've seen it. It was one of the questions that popped up. One of the first questions that popped up as we started the discussion, and this is on the treatment of investment allowances in the transition period in granting allowances on reducing balance basis and straight line basis. And I think I can pick a question that came in from an anonymous attendee, and his concern or her concern was that the KRA template has not been updated to compute allowances on a straight line basis. Please advise on how to go about filing the income tax returns. So maybe you can clarify to us what is this straight line and reducing balance basis, even as we try to advise our taxpayer who has said that the KRA template has not been updated to compute on straight line basis.
Thank you. Now, straight line means now English. It means straight line.
Okay.
Now in straight line, what we do, the rate that is given is always applied on the cost. So if your asset costed 100 million, in the first year, you are doing 50%. So it is 50% of 100 million. In the second year, you're doing 25% of 100 million. In the third year, 25% of 100 million. So by the third year, you are at zero. So that is straight line, simple. Reducing balance, on the other hand, now you apply the percentages on the balance having been reduced with the claim for the previous year. So if you do 50% in the first year of 100 million, you are down to 50. In the second year, you're doing 25% of 50 million. So 25% of 50 million will be 12 point something. So you remain with 37.5. Again, in the third year, you do 25% of that 37.5. So mathematically, you'll never exhaust this value. It will go reducing, but for so many years, you will find in the straight line, you exhausted this asset in 4 years. And a reducing balance, you still be carrying this asset 20 years down the line, but maybe it will be worth a few hundred shillings. Yeah, so that is why actually we moved from the reducing balance to straight line for clarity. You can imagine in the past, like buildings used to get 2.5%. If you do that on straight line, it would take 40 years to amortize that business. If you go reducing balance 100 years down the line, you still be having a 2.5% of some small figure. Now you can imagine trying to look back on how this cost was incurred. Yeah. So then now for the transition, remember in the old schedule, we were using reducing balance. Now come 2020, the law changed to the new schedule that is now, actually it changed to straight line in 2021. In 2020, it was still talking of reducing balance. Then 2021, it was changed to straight line.
Straight line.
Yes. So now transition from the old schedule to the new schedule, the balances that were being carried forward from the previous schedule, provisions of the previous schedule, were supposed to be migrated and claimed now under the new schedule, under the provisions of the new schedule. And by 2021, then those balances should have been exhausted. You convert them to straight line. And if you look at the cost of the asset, if you apply 25% on those balances already in 1 year, it's gone.
Yeah.
Yeah, so I don't know whether whoever had asked the question has understood it. Yes.
Okay. And have these changes been accommodated in our returns, maybe, to factor in the straight line basis? Because I think his concern is that the template has not been updated to compute on a straight line basis.
I want to believe the current template, if they download the current template, those rates are now in straight line. But what we can do, we can pick the contacts of that taxpayer and assist them on the sign rate.
Okay, so maybe we can be able to confirm that before the end of the presentation.
Yes.
Okay, thank you for that. And I think we've now entered into our Q&A session. And if you have a question, you can please note it down. I can see they have come in quite a number. And I've also seen your hands that are going up. So allow me to start with the Q&A, and then I'll pick you. I'll give you a chance to talk. So we have our participant, Kalpesh Patel. Thank you for joining us. And your question is, if the company has tax losses due to investment allowances, but there is accounting profits upon declaring the profits as dividends. His first question is, why is the taxpayer charged a 30% tax? And the second question is, if anyways it is being taxed, then what is the purpose of the investment allowances? As an investor, I don't see the benefit. So that is Kalpesh Patel. Maybe you can react to that, Victor.
Maybe you can come back again on the last part of that. What is being taxed? Or just repeat the question, please.
So his question is, if the company has tax losses due to investment allowance, but there is accounting profits upon declaring the profits as dividends, why then is the taxpayer charged 30% tax? And the follow-up question is, if anyways it's being taxed, then what is the purpose of this investment allowance? As an investor, I don't find that benefit. I don't know if it's clearer now.
Now, if you are in losses as a result of investment allowance, these losses are available to knock off against the, remember, we have specified sources of income. So if you have losses under business income because you claimed investment allowance, any charge, whether it is a trending receipt or any other income in that line, will not be taxed until you exhaust until you exhaust the losses that are in that line. Now, dividends, the tax on dividends is not on the company, it is on the recipient. So now this is not tax on business income that we are talking of, but tax on dividend, being tax on the person who is receiving the dividends. Or you could be having losses in the business income line, but on the interest income line, you receive some income. You cannot use the losses under business income to knock off the income in the other line, either interest or agriculture or rental. So we have to always remember section 15 has specified the sources of income where expenses or losses cannot be knocked off from the other source.
All right. So I think that is how to go about it, Patel. But if you still have a question on the same, you can do a follow-up. We'll be able a follow-up question. We'll be able to read it out to our panelists. Fahad Swaleh had a question about how to file investment allowance of 150% when the return only allows you to do up to 100%. Okay.
Thank you. Again, we can assist them on that. What I've seen taxpayers doing, you list the asset as required, the description under the investment allowance section. But then when you go to the tax computation, it allows you to find the correct amount, which is 150%. Remember, after the computation for depreciation, I mean for wear and tear, for investment deduction, okay, you'll still find them described as such in the Act, because some of these changes, the 150%, came in the 2023 in the 2023 return. So some changes will be done to the return as we get to June. But in the tax computation, it allows you to find the correct figure, even as much as the schedule where you have described the asset is limiting it to 50%. Yeah.
Okay. Thank you for that. We have another participant, John Karani. He's asking, kindly elaborate on wear and tear. And I think it's one of the questions that we had. What is the difference between wear and tear allowance and investment allowance? And then he's also asking about the new classes and the rates for wear and tear.
Thank you. So wear and tear is a term that was in the old schedule. Currently, everything is called investment allowance. So it is just the rates that will change. So a person who was used to claiming wear and tear on motor vehicles will now find the same motor vehicles listed under investment allowance and given a 25% investment allowance. They used to get 25% wear and tear. So the name has changed from wear and tear, from investment deduction, from industrial building allowance to a uniform investment allowance.
Investment allowance.
Yes.
Okay. Okay. Thank you for that. Joseph Umbungi had a question about rental, and I think we talked about residential property as not enjoying these investment allowances. So he's asking, what allowances can I claim from residential apartments?
Now, remember, investment allowance is an incentive. We started by saying under Section 16, capital expenditure is not allowed as a business expense, other than is provided for under Section 15. Then Section 15 sends us to the second schedule, where some select assets and businesses are picked to be incentivized by the government because they want to direct investment or encourage investment in certain areas or certain lines. So you'll find there are capital expenses that are not claimable because they are not there in the schedule. There are those that are not there today that probably come June will find their way in. There are those that are there today, but as the economy changes, now government decides, let's stop giving this incentive in this area because we've had enough of investment in that line. So for now, for residential buildings, it is not there in the second schedule. But having said that, If you go to section 15, some capital expenses are allowed for residential buildings if the expenses are necessary for the landlord to maintain the existing rent. So, but we are not talking of replacing the building, but maybe there was a problem with the roof, tenants are leaving, so you replace the roof. That is a capital expense. Under section 15, that is allowed. You're allowed to claim that if it was necessary to maintain the existing rent. But if you make that change and the rent goes up again now, that becomes a matter of discussion because you did not do it to maintain the existing rent, but to hike the rent. So it just goes in as capital expenditure that will not be allowed.
Okay. Right. Thank you for that. We move on to Chris. Chris is asking, my company is thinking of either buying a newly constructed office block, not in use, hence no allowance claimed yet. So they're thinking of either buying a newly constructed office block or constructing a new office block. So the question is, do both qualify for the investment allowance? And if they do, what are the rates?
Yes, thank you. Both will qualify. Is a straight answer. If the building has not been used, they will acquire the building and then compare one, the cost that was incurred in constructing that building and whatever they have paid for it, and use the lower of the two to claim their investment allowance. Now, that will go in as a commercial building. Remember, we handled it for commercial building. Do you remember how much it was?
Commercial building.
Yes.
For the first year of use,
Mm-hmm.
I think it was 50%.
No, no, for commercial building, it is 10% in straight line. So we're talking of 10 years. Yes. They can
To
also
get to the
construct.
100. Okay.
Yes, 10 for 10 years. They
Mhm.
can also construct their own building, so long as it is used for commercial purpose. Again, the cost that they will incur in constructing that building will become claimable at the rate of 10% in a straight line. Or they can go to a developer, a person who is in the business of developing buildings for sale, acquire and make it their office building. Now, if they go to the developer, what we said about comparing the cost of construction and the selling price does not apply. They just claim on the selling price. So they can make that choice, either construct or buy. Either way, it will qualify. Yes.
Okay. Thank you for bringing out that clarity. I think there are a lot of rates, percentages, and all that. But I think, and I think that's why we have most of our participants asking, including John Karani, where can I get all this information? Where is it mentioned? So that he can make like a referral, or you can give us some guiding sections where we can get this information, because I've seen it's quite a recurring question from our participants.
Yes, the main source, the landing point for all this is the second schedule to the Income Tax Act. Of course, we said it gets its authority from section 15 2, but that is nothing much to worry about. The main thing
Yeah.
that we need to get is the second schedule.
The second schedule.
Yes.
All right. Thank you for that. We have another question about, and it goes like this: after claiming the 100% of the cost, should the investment amount still lie in the balance sheet under fixed assets?
Yes. Now this is accounting versus tax.
Mhm.
Remember, in accounting, they are accounting for depreciation. So they'll say, I have my machinery here, the cost is this, the depreciation for the year is so much. So depending on how you are reporting, whether you want to carry the cost and accumulating depreciation, it will always be there in your balance sheet. If you want to carry it at reducing balance, again, the reducing balance will always be there in your balance sheet. That is for accounting purpose. Now, whatever we are discussing from the second schedule is for your tax computation. It doesn't affect your balance sheet. Even if you get 100%, which reduces the value to zero, that is for tax purpose, for tax computation. In your balance sheet, you are still maintaining your assets as per your accounting policies in your company. Yeah, thank you.
Okay, thank you also for that. I'll try to move on a bit swiftly because we have so many questions and I can see our time is running out fast. I'll combine a question about which investment allowance does drilling of a borehole qualify for, with a question also from another participant who's asking, kindly mention the rate for borehole and swimming pool. Okay.
All right.
Mm.
So by themselves, they may not get a rate. Now, those would qualify depending on what they are used for. For example, if I'm in manufacture and I need water to run my manufacturing process, then the borehole becomes part and parcel of the building for manufacture. If I'm running a hotel and of course I want my customers to enjoy themselves in a swimming pool, and if I do not have a swimming pool, they'll go to the next available hotel. Then the swimming pool qualifies under the hotel. Now imagine a situation where you have a swimming pool and manufacture. You are doing manufacture, then you do a swimming pool. Do you think that is helping you to generate your income? And the answer will be no. Yeah, so when we look at the definitions, for example, for building used for manufacture, let me try see whether I have it here. Building used for manufacture includes any structure or civil works deemed to be part of a building where the structure or civil works relates or contributes to the use of the building. So you can see now civil works, including things like boreholes, come in under that umbrella.
Yeah.
Yeah, the same thing where we say machinery used for manufacture means machinery used directly in the process of manufacture and includes machinery used for the following ancillary purpose: generation and transformation and distribution of electricity, because you may have a generator in your farm that you use to probably light up the area or do other processes, but the generator in itself would not have qualified. Cleanup and disposal of effluent and other waste products, again for environment, reduction of environmental damage, water supply or disposal, remember that borehole, maintenance of the machinery, because again, you might have a workshop there where when something breaks down, you send it there, and scientific research and development. So this is where now such items that would make the main process function come in, but they will not qualify as a standalone item.
Yeah.
Yes.
Thank you. I think that is very clear. I'll ask a question from Niraj Shah, and they're saying, what is a smartphone or iPhone classified as? Is it a telecommunication equipment or computer and peripheral items, as it has a capacity similar to a computer or even more than just a handset?
Now, question number one will be, what is the smartphone being used for?
Used for, yes.
Yes. Once we confirm that it's being used for business, then it will fall under telecommunication equipment. Yes.
I think that is brief and to the point. Yeah, it's in line with the business, used for business, then it qualifies, it falls under telecommunication equipment.
Yes.
Okay.
Yeah, the key thing is where in business it's being used for. I mean, are you in the business of making phone calls? Yes.
Okay. All right. Allow me to move to our next participant, Mr. Franklin Kabaka. You're saying thanks for this webinar. Thank you for joining us too. And he's saying, for a company carrying out construction of its building, and after one floor is done, they occupy it as they keep constructing the other floors, can it initiate the claim of investment allowance on this first floor?
Yes, the answer is yes. If that first floor is complete and it's been used to generate income, then they can claim. When they do the second floor, then the second floor will be treated as a new building. And then again, they can claim in the first year when they bring it to use. Yes.
Okay. All right. We have another question about does a private investor require approval from a relevant treasury or commissioner before claiming the investment allowances, say a school or a hotel developer?
From the commissioner, no. But they will need to be licensed by the relevant authority. If it's a school, then it needs to have all the licensing that allows a person to operate a school. So I remember an example, a question someone asked somewhere, can they claim that they have a structure in their church where they use it for Sunday school? And of course, the question was, have you registered this Sunday school as a school? And number two, is it generating taxable income? So if it's a hotel, it needs to be registered as a hotel from the ministry responsible. If it's a school, it has to be registered. So the commissioner for income tax will only come in to review while you have claimed, once you have claimed that is the asset there. Is it certified by all relevant bodies that are supposed to certify? You can imagine if you are manufacturing alcohol and you do not have, for example, licensing from the licensing board, then would you say you're in that business? Yeah, so those other government arms and other licensing bodies have to come in to license you then for the commissioner, they will just be confirming that you're properly licensed by the relevant authorities.
Thank you. Thank you. Okay, allow me to move now to Nancy. Nancy Dalla is asking, is a greenhouse considered under building or farm work? Greenhouse.
A greenhouse is a place where you grow plants, right?
Mm-hmm.
I'm making that assumption.
Mm-hmm.
Because again, it is the use that will guide us.
Yeah.
So if it's a growing of crops that happening there, then it will be claimed under farm works.
Okay. Right. Thank you. Admin is asking, what of pharmaceuticals distribution? Is there allowable expenses for that pharmaceutical distribution?
No, for distribution, unless on the building. If they have a building, then that will qualify as a commercial building, because that's a shop, right?
Mm-hmm.
Or they are using it to store their products. But the person who is manufacturing the pharmaceuticals then would qualify under the manufacturer. If these pharmaceuticals are being distributed in a hospital, then again it changes and qualifies under hospital. But if it's the chemist or go down where they are doing their sales and distribution, then that qualifies as a commercial building. Yes.
Okay, thank you. Francis Kanyora, you're asking about, can you claim investment allowance in motor vehicle and wear and tear on the same motor vehicle? And I think you already gave clarity on that, they now fall under one umbrella called investment allowance. There's no separate wear and tear and other investment allowances, if I'm not wrong.
You're right. You're right.
Okay. All right. We have so many questions. There are over 50 that are still unanswered, and I can see we are running out of time. So I don't know how we can do this, because Jayesh Patel, I can see you. There are other questions that are quite lengthy. Jacinta Ayoye _ Masanga. We have Franklin Kabaka still here, Veroline Ajambo, and their questions are yet to be answered. Okay. And we also have these ones who've raised their hands. I don't know how we are going to do this. Maybe I can allow these ones who raised their hands to say their questions. Maybe they fall under the same category of asked on the Q&A, so that we also have a balance, because I can understand we also have an audience that has joined us live on our KRA TV platform, that is our KRA TV on YouTube, and on our website, KRA TV. And there are also questions there that we are yet to answer. So maybe our panelists, you can give me guidance, but I think I beg to also give a chance to those who've been raising their hands. I'm sure they might be having questions that will be related to what we have on the chat. You can give me a guidance on that, maybe.
Of course, this is a topic that we can discuss for a whole day because of
I see that, yes.
the diversity out there. So on the issue of time, maybe there are those that we can pick and reply directly to the taxpayer. Of course, then everybody else will lose out on that discussion. That's 12:59. Yeah, or you can give us a few more minutes. You have you are the one with the pass.
Let me also inquire from my sign language, Elizabeth, because I understand also the nature of her work. There's the way if it's a lengthy discussion, then you need at least two to do the signing. I don't know if she's comfortable with this to proceed for a few more minutes. Maybe Elizabeth, you can also give me guidance on that.
Yeah, of course, I'm a bit tired. So my direct answer would be no, we shouldn't continue, but we wouldn't want to lock out taxpayers. Maybe if there's a way we can handle their questions later, probably that could help.
Okay. So just to be fair, maybe we can add a few more minutes. Let's say 10 minutes. We give the ones who've raised their hands a chance to speak, because I can see like Kalpesh Patel, your hand is up. Jayesh, your hand is up, and you also have questions in the chat. So allow me to give them the chance to ask their questions, and then so the three, I can give the two who've raised their hands a chance to ask their questions, and then maybe we can organize for another session, because I know we cannot exhaust all the questions in this session. We can organize for another session and invite you guys, say this week, so that we don't also take more time. We can do another webinar, say on Friday, and then we can, if our panelist is okay, we can schedule some time on Friday to just respond to some of these questions that we have, because I understand we cannot exhaust them all in this session. So CPA Victor, is it okay? Maybe we do another session, say on Friday, to cover on the questions maybe that would not have been covered in this session.
That's fine with me.
Thank
Yes.
you. Asante sana. So for our participants, you don't need to worry. We can proceed with the answering your questions, say on Friday. We'll do another link and share with you, so that we also consider our sign language interpreter, and also in the interest of time, because there are other programs that will come in after this webinar. We'll be able to proceed on Friday. So if you see the link, you can share with a friend. We'll have another session on Friday from 11, and we'll proceed with the same sensitization. So thank you very much for understanding. So allow me now to give Byron Shah a chance to unmute themselves and talk. So Byron, you can go on with your question. You can unmute, Byron, and ask your question. Okay, maybe we can move on to Niraj Shah.
Hello.
Hi.
I just had a follow-on question on the issue about smartphones. Mr. Victor explained that if you're in the telecommunication business, then it goes as 10%. My question is actually not as regards a telecommunication business, but it's regarding any other business where you use smartphones in your business to do your bank transactions. You may use it to do your corporate work. Does that then become still telecommunication equipment? Because the smartphone is probably even more powerful than a computer. What sort of allowance do we get? Thank you.
All right, thank you. Victor, maybe you can react to that.
Yes, it's still on telecommunication equipment, because you are using this for communication. Now, it can shift if now you're using the same, for example, as part of your computer network. So it passes through as a peripheral equipment for the computers. But if it's just for telecommunication, then it goes in under 1B8, telecommunication equipment.
Okay. Niraj, is that sufficient?
Sorry. I think I still am of the opinion that the smartphone is as powerful as a computer, if not more. And besides just using it for communication, it does much more than that. And I personally believe that it should be part of the computer and periphery item as your wear and tear claim or investment claim. If it was just a telecommunication equipment, then an ordinary phone, like something which costs very little, would have been bought just for communication purposes. And that's the reason why I question whether it should be telecommunication equipment or whether it should be computer periphery.
Yes, I get your question, and the answer will still be the same, because I started asking about what you use it. Remember, the schedule does not look at the power; it is the use.
So if the use is for business
look
purpose,
at the telecommunication equipment, actually they are more powerful. Whatever is covered in that line is even more powerful than some of the computers we have in ordinary businesses. But it is the policy. Do we need to give an allowance of 25% for this equipment, or 10%? And what the law has provided for is 10%. It is not because of the power. Of course, even at home, I'm sure you have a very powerful phone and with some functions that you do not even use. But that does not make it qualify, because you are not using it, one, for business, and it is not allowed in the schedule. So what has been given in the schedule for telecommunication equipment is 10%. What is given for computer and peripheral hardware and software is 25%. I don't know whether that has come out clearly now, because it's not the matter of power. It is what rate has been given for this type of equipment.
So even if you use the smartphones for your business purposes, it still doesn't qualify for the computer section as 25%.
No, it doesn't. Remember, for it to be given the 10%, it has to be used for business purpose. If it's not used for business purpose, it doesn't even get any investment allowance. But the rate that you get as investment allowance when you use it for business purpose is 10%, meaning you write it off over 10 years.
So if this equipment gets obsolete within 3 or 4 years, because that's what happens with smartphones, and if they are taken in for business purpose as the company's requirement, then it still gets only 10% as opposed to 25%.
Now, if after 3 years you cease to use it, remember there is a proviso of when you stop using the asset, either you have disposed it or for any other purpose, you determine the market value of that asset at that point and net it off against the residual value for that particular asset and establish whether you have a trading receipt or a trading loss.
Okay. Fine. I'm not too convinced, but I think then the policy needs to look at whether the smartphones actually come as computers, because they are as good as that.
There are two ways of going about this. Sorry, let me power my machine. Where you need further guidance on an issue, you can apply for a private ruling. You write to the commissioner, it will go to the policy unit, where then they can give you a policy guidance on the classification of any of these items or any other matter relating to interpretation of the tax laws. The other thing is, if you feel there's something that has not been granted an allowance, and in your opinion it should, again, you can engage Treasury in the budget making cycle. And that is how some of the things come in. We said there are things that are in the schedule today. We don't know, come June, they will be kicked out. Others will come in. So it's a dynamic schedule.
Okay, fair enough. What's the procedure for applying for a private ruling?
You just need to write a letter, explain what it is that you want interpreted, and drop it at your tax service office. Or you can email. Cynthia will give you an email where you can send it. Then
okay, thank you.
The commissioner will get back to you on any issue.
Sure.
Okay, thank you. Thank you for sharing that.
You are welcome. Okay, so we have one last participant, Jayesh T. Patel. Please unmute yourself and ask your question or concern. Welcome.
Okay. Victor, good afternoon.
Good afternoon to you.
Okay, I just had a question. If we make 100 million investment and we get 100% allowance for that first year, then you make a similar profit of 100 million. Means that specific year we do not pay tax because of the allowance. So that is the accounting profit that goes into the retained earnings. Now the next year I want to give out dividends on this retained earning. So can I pay the 5% and share the dividend, or do I also have to pay the 30% corporate tax as per Section 7A?
Now, remember, why 7A is coming in is that the government wants to encourage investment. But if you are making the investment allowance and then distributing the money, then the government's effort was futile. That you are getting the allowance, basically your income is being exempted, then you're just distributing it. So that is why then it's being recouped.
Then where is the benefit then?
The benefit is to encourage investment.
But that's what you've done.
Sorry?
But that's the investment you've done, 100 million.
You did the investment, right?
Correct. We did an investment of 100 million.
Yes.
Okay. So we got 100% allowance from KRA.
Yes.
That same year, we made a profit of 100 million. So we didn't have to pay any tax, right?
Yes.
So we have an accounting profit of 100 million.
Yes.
Which goes into the retained earnings in our books.
Yes.
Now the next year, I want to now declare dividend on this same 100 million.
Yes, and on the other side, there's no tax you've paid.
Yes, correct, because of the allowance.
Yeah, meaning you did not need you did not need this allowance in the first place.
But you're already giving us allowance for investment.
Yes, you're giving.
I don't need it. I need it.
Sorry. Yes, you've gotten the allowance for the investment, but then you are distributing the same profit. having used the investment allowance to avoid paying the 30%.
We are not avoiding, it's an allowance you have given, right? So
Okay,
if it
yes,
is
but
a benefit,
yes, but why?
Then okay, Victor, 1 second. So the bottom question is, then where is the benefit? I have not paid the tax for that 1 year, right? Because of the allowance. So that money is in my retained earnings. So are you saying that that money lies in my retained earnings for 100 years or till my business shuts down?
Well, as we said when we started, it is government policy, right? That if the government feels that they are granting you this accelerated expenditure, but then instead of reinvesting, you are distributing. So the money is leaving the company. The government has not gotten the tax. You get the dividends at 5%. So you avoided paying tax at 30%, and you are distributing dividends. So the only thing the government is getting is 5%.
Correct.
Yeah, so that is where then Section 7 comes in.
Yeah, but you see now that would mean that the allowance you're discussing here is actually not an allowance. It's just a cash flow which you're just saving.
Well, now that is another. Remember, this is in the law. Here we can only discuss how you are supposed to comply with the law. If you feel a law is unfair, again, you engage Treasury with the aim of changing that law. But when it is law, we enforce it as it is.
No. We are not saying it is unfair. It is not rightly stated. That's maybe the right English word I can use, because you're on one hand telling us there's an allowance, come and invest. Okay, so everybody goes leaves other countries, comes to Kenya. The guy invests here 100 million. Then you tell him now this tax you must pay. So where is the real realization of the investment benefit? I don't see it happening.
Well, it is there until the point you decide to distribute.
Yeah, so in essence, it's only a cash flow, which you're holding on to for 1, 2 years or 5 years. Isn't it?
Yes, that's why I said, remember, here we are only guiding you on implementing the law as it is. Now, here you are raising an issue of the law being unfair. Okay?
No, it's not unfair. It is wrongly stated. Then you just read there that you will benefit cash flow of not paying the tax. Don't say investment allowance, because allowance means that it's money you should get. In this case, we are not getting it.
It doesn't give you money, Mr. Jayesh. It allows you an expenditure. It's not supposed to put money in your hands.
When I give you pocket allowance of 1,000 shillings, is that 1,000 shillings comes to your pocket?
When you give me?
Allowance is allowance. Allowance is there should be some realization.
No. Okay, I'm not getting the issue of you giving money, because here you invested in an asset, right?
Right.
And you used it for trade.
Right.
At the end of the year, you've made a profit.
Right.
Against this profit, you're supposed to pay tax.
Right.
Percent. Okay?
Correct.
You claim investment allowance.
Yeah.
You end up not paying any tax.
Correct.
You're supposed to reinvest this money. That is the idea of encouraging you to invest. But now you are distributing. So this money that you never paid tax on is ending up in somebody else's hands, which is not the business. Now, at the point it leaves, then tax becomes payable.
But this money is still being reinvested either way, because at the end of the day, sooner or later, the investor has to remove that money, right? It is a matter of time. If it not be, maybe it's not in 1 year, even in 10 years, even 20 years. But one day, the directors will say, okay, now withdraw the money.
Yes, At the point, remember when once the company has now gained its hold, because we expect that company to start paying taxes. So it doesn't give you, it's not giving you a tax holiday. We're encouraging you to invest, but we also hope that with time, you will start paying taxes, even for those institutions that are given tax holidays. At the end of the holiday, we are happy when they start paying taxes. So investment allowance is not supposed to protect you from taxes forever. It's just helping you to gain your standing in the first year when you start, when you are having that huge capital.
Okay. So basically, it is just a cash flow which you're using to reinvest until you feel that it is now done.
Well, I'll limit myself to calling it what it is called in law, because if I call it a cash flow, I do not know how I will describe it to you when you come for a private ruling.
Yeah, but because in essence, actually, that's the effect. That's what's actually happening. Eh?
Yes, I agree with you if that is how you see it, but then the law is very clear, and we have to apply the law as is formulated.
Okay, thank you.
Okay, thank you, Jayesh, for your inquiry. I think our panelist, Mr. Victor, has put it very well. And with that, allow me now to bring our discussions to an end. I want to thank all of us. I can still see that we have quorum up to this time. Allow me now to end it at this point. As we have agreed, we will have further discussions on Friday. Should you feel that your question has not been addressed in this session, please feel free to join us in our Friday session, of which I'll send the link to your emails. You can join us again on Friday from 11. Otherwise, I want to give our panelist, CPA Victor, some time to give us his parting shot. Victor, over to you.
Thank you, Cynthia. It's been a short, is it 2 hours?
Yes, they're about, yes.
Yeah, this topic is always very interesting. And yeah, believe me, we can discuss it for several hours. But it is one of those key provisions in law that is actually aiming at supporting businesses as they come up, new businesses, so that they can get a foothold and be able to compete with others out there. The schedule is still young, having come in 2020. A lot of changes are still coming in, the latest having come in just last year. But all in all, it is a well appreciated schedule out there in businesses. You look at every return, you'll find a form or so of the investment allowance. So having said that, we'll continue supporting our taxpayers to understand this and other provisions of the law even better going forward. And thank you for having invited me today to participate in this discussion.
You are welcome, and thank you also for just taking your time and educating us. I know it's a wide topic, but I think we have tried to discuss it in a way that is understandable in the simplest terms. I know some English has not been Englishing, but we'll have another session to further clarify some of these things, some of these areas that are still a bit gray on our taxpayers' end. Another big thank you to our sign language interpreter, Elizabeth. Thank you so much for joining us and even going the extra mile for the minutes that we've extended. I hope we can be able to have you again on board on our next session. Our online audience tuned in on KRA TV platforms, I cannot thank you enough. And I'm sorry we've not exhausted your questions on the chat, but please share your emails with us. We'll be able to invite you for our session on Friday. You can join in to have your questions addressed there. And with that, allow me now to thank also our participants who've been in this forum from around 11:30 to this time. Thank you so much for joining us, and see you again on Friday. So before I finish off, allow me to end it with a word of prayer. Almighty God in heaven, we are thankful for the opportunity you've given us to learn on investment allowances. It's a wide topic. We've not exhausted. We ask you to give us the willingness to join again on Friday to further learn on this topic and even expand on our knowledge base. Lord, we thank you for our sign language interpreter. We thank you for our panelists. We thank you for our participants who've joined us in various platforms. Thank you so much for all of us. Give us a good afternoon. And when we shall meet again, we shall remember to give you thanks. It's in Jesus' name I've prayed, trusting and believing. Amen. So thank you, everyone. We are free to live at our own pleasure, and it's been wonderful having you. Have a good afternoon and see you again on Friday. Thank you and bye-bye.